All right, we are here live with Lawyer Radio, and my special guest today is an old friend and a new friend. I'll explain more. Amy Malamut from HMA Mortgage. Did I say that right?
You did. You did.
Oh, good. I got the initials right. We're good.
Yep.
And the reason Amy is an old friend and a new friend is because she, even though she's in the mortgage business now, she was a divorce lawyer for many years.
That's right. Yeah, for about 10 years. Yep.
Yeah, so you know what we deal with. So you know basically all the questions that I'm going to ask you and all the things we're going to talk about. And I think it's actually really nice that you have that background because you are in a special position to really understand what a divorcing couple is going through and the challenges that they face as they are leaving a marriage and talking about maybe refinancing a house or having to make changes in their lives and get a new house. Yep. So I think that's kind of nice that you have that experience.
Yeah. Yeah.
Well, thanks for coming on here today.
Of course. Thank you so much for having me.
Yeah. And so what I want to talk about today for our audience is the kind of things that people should be thinking about and should be aware of as they think about divorce, as they go through a divorce, if they're just beginning the process or if they're kind of at the tail end, because you actually told me some things that I didn't even know, that one of those things that you have to start the process a little bit early than maybe everybody thought. So why don't we just start at the beginning, Amy?
Sure. Yeah, sure. So, so I mean, when I was a divorce attorney, a lot of times, as you know, we would put into an agreement, let's say somebody wanted to keep the house, and you would put into the agreement this boilerplate language like the wife has 60 to 90 days to refinance the existing mortgage and buy husband out of his share of equity, and then the house becomes hers and the mortgage is in her name alone. And what I found, I think I've really gotten into this kind of mortgage divorce thing in earnest over the past year, but what I've really noticed is that 60 to 90 days is very typically not enough time. Some situations it is, but a lot of times it's not. It can be enough time if you started the process during the divorce, but if you just call me up and you say, I have 3 months to refinance, here's my situation, more often than not, I'm going to tell you like, whoa, you need more time than that. And I'll go through why today. But that's the biggest thing is like, I think people don't understand is they really need time. Time is of the essence. Not only do you have to time these things, but you need to give us time and give your mortgage professional time to get your stuff in order to be able to make this happen for you.
Well, this is actually not something that I even knew. And I don't know how long you've been in mortgages now, because as I said, you were a divorce lawyer before.
Sure.
That you're right. That's a very common provision, 60 to 90 days, because usually the person that is keeping the house, they don't want the other person dragging their feet. They want it done. They want it done quickly.
Sure.
And so my perspective, if I was representing the person staying in the house, is we want them to get this done. There's no reason for this to lay around forever.
Sure.
But it sounds like 60 to 90 days really just isn't fair to the other person.
Exactly. And also if you're working with a mortgage professional and they could tell you, okay, 90 days might not be enough, but if you can give her or him 4 months, 5 months, 6 months, if you can talk to someone who knows what they're talking about and they say, this is how much time they're going to need, I think that would put that person at ease. You know what I mean? Not just, sitting at the table with the lawyers and the litigants and saying, well, I want this much time. Well, Amy is telling you this is how, if you want to get this deal done, this is how much time you need. I think maybe coming from a third party, it might just land a little bit better, just like it lands a little better when a forensic accountant does a business valuation. Well, It's not just wife or husband picking a number out of thin air. It's a professional telling you this is how much time you need.
Okay, and we're going to talk about why and what people should be doing during that time. Because it doesn't mean that if you get 6 months, you go sit on your couch and wait until, the last week to start doing things. So what are the things that someone has to do during those 6 months?
Sure. Well, so I have like a list of things that should be happening. And the first thing is to really talk to a mortgage professional as soon as you can. It could be before you even file for divorce. as soon thereafter as possible. The more time you have, the better. And here's why. Number one is your credit. I don't think people realize how much credit matters when you're qualifying for a loan. Whether you want to refinance or buy a new house, your credit really matters. And there's so many people who I talk to who are like, I haven't checked my credit in 10 years. I have no idea. It could be in a dumpster fire or it could be like an 800. I have no idea. So you really need to get your credit checked and get it in order. Also, those apps like Credit Karma aren't necessarily what a mortgage company is going to use. They're going to use this 3-bureau model where they're looking at Experian, Equifax, and TransUnion, and we're taking the middle score. So if you have one of those apps, what we're going to look at might be very different. So you want to talk to a mortgage professional like me, have your credit run. There's a couple things that we can do. If your credit is like, I might be able to tell you, here's what you need to do to just get it where it needs to be to qualify for a particular type of loan. That could take a year. It could take a month. It could take 2 months. So people don't realize how important that component is. It's really important for the divorce attorneys too, because a credit report can tell you a lot about debts that you might not have known about, especially if there's like a joint credit card or some sort of joint home equity line that the husband signed off of and the wife doesn't know about. So there's like a treasure trove of information there anyway. So that's like a really big thing that you can start working on as soon as possible.
Is there a rule of thumb as to, at least the bare minimum that your credit score has to be?
So for an FHA loan, which is like your government loan, we need at least a 580.
That's actually pretty low, isn't it?
It's pretty low, but I'll give you an anecdote. I had a client the other day, or potential client, who honestly probably could have qualified to refinance the mortgage and buy his wife out. With his income was pretty good and the numbers would have worked out, but his score was a 515. And the things that were ruining his credit were things that really were not an overnight fix. I mean, he really would have needed a long time to fix it. So had he started that process a long time ago, perhaps he could have. So a 580 is doesn't sound so unattainable, but there are people with worse scores. For a conventional loan, you're looking at like a 700. Something around.
So when you say a conventional loan, as opposed to what is the FHA loan that you were talking about?
An FHA loan is usually more for like your first time home buyer, maybe someone who makes a little less money, has a lower credit score. Your conventional loan is a slightly more sophisticated buyer. They maybe have more income. They have more money to put down. A lot of times with FHA loans, if you're buying a new house, you can put down 20%. With an FHA loan, we have a lot of people that are only putting down 3.5% of the purchase price. So that's your difference. And I'll get into more with even with alimony, there's different rules for FHA loans and conventional loans as well. So that's another thing you should talk to your lender about, because you might not be able to qualify for a conventional loan, but you can qualify for an FHA loan. So credit is a huge thing that you should start working on as soon as possible.
Okay, so people that are thinking about divorce or even in the beginning process, and this is for anybody, who's a potential client here, but also if you're an attorney watching this, probably a good practice to make sure that your clients very early in the process take a look at their credit scores. Yeah. Because a lot of times we don't know in the beginning if someone wants to buy someone out, if they want to sell it. Sometimes people have an idea what they want to do, but don't have an idea of really how that's going to land or the capability 100%. That they may have to refinance something.
It's totally all about the capability. And let's not spend 2 years arguing about keeping a house that maybe the answer is you're not going to be able to.
Let's not wait until, the day of the uncontested hearing to start talking about, what somebody's credit score is. So do that early. Okay.
Another thing is too, especially if people are going through a pretty acrimonious divorce or separation, there might be, let's say, husband always paid the mortgage or wife always paid a credit card bill, and they might have just stopped paying. I mean, how often does that happen? And that could have tanked the credit score. So you want to check it and get it back on track as soon as possible. So especially in a divorce context, you want to keep an eye on your credit report.
Yeah, and this goes to people too, that even if there's not a refinance situation, you may want to take the proceeds from the sale of a house or whatever your situation is. You may want to buy something later. So,
Absolutely. It goes both ways. And it especially goes for the spouse who's maybe not keeping the house and needs to buy something, because they might be getting kicked out of the house in 60 to 90 days. And then what are they going to do? If they're not going to rent and they want to buy, well, they need to be able to buy something. And most people need to get a loan. You can buy something cash free, but
they need a pretty decent credit score.
yes,
fairly decent, but not spectacular. It doesn't have to be spectacular. So, I know there's people out there that brag about their 800 credit scores.
Right.
You don't have to have that. There's still options for you.
Yeah.
But what else do they need? Is there a rule of thumb as far as what their income has to be?
Sure. So, debt to income ratio is a huge thing. And I'll just keep it pretty simple, but you can't have your monthly debts take up too much of a percentage of what your actual income is. And that's such a great question, because I have so many people that call me and they say, oh, well, I have lots of money in the bank, or I have a big retirement account, and I'm going to get this big buyout when I get divorced, so I should be good. Well, unless you're using all of that money to buy a house outright without a loan, you still need to qualify for a loan. And I don't care how much money you have in the bank. I need to be able to show that you will be able to make monthly payments on your mortgage. And that's where income comes in. So an income could be just it could be from employment. It can be from Social Security. It could be from an annuity. It could be alimony, and it could be child support. So many people going through divorce, if they're receiving alimony, you might need to count that alimony as income. And I can also go through, there's a lot of tricky things with that I think a lot of people don't realize.
We're definitely going to talk about that, but I want to go back to something you said. You said debt to income. Are you referring to the principal balance on what a credit card, student loans, all of that, all the debt? Or are you also referring to the monthly payments for each of those things?
Yeah, so I'm really referring to the monthly payments, right? We're talking about your monthly debt and your monthly income. So when it comes to your housing expenses, your monthly housing debts, that's your mortgage principal, your mortgage interest, your homeowner's insurance, your real estate taxes. In some situations, you might be paying mortgage insurance, a monthly mortgage insurance. If you have HOA fees, homeowners association fees, all of that is part of your debt to income. Okay. And that's one part of the picture. And the other part is we take all those and then we also add in if you have monthly car payments, monthly credit card payments, all of that. And it's a little complicated to go through the exact ratios now, because it also depends on your credit score and all different things. But it needs to fall in a certain range in order for you to qualify for a loan. So I don't think people understand, if you don't have any income and all you have is money in the bank, that might not help you for getting a loan. Okay.
So is there a range that you like to see the debt to income ratio?
Sure. I'd say it's like a 40 to 55%. The lower the better. Okay. We see people come in with 8%. That's great. If they have a lot of income and they're trying to get a pretty small loan, it's not going to be a big, debt to income ratio. But something in that sweet spot. And again, it really depends on the loan type and your credit score and all of that.
Okay. So I want to talk about, as far as the income is, alimony, child support, because I know many years ago, and I think it has changed a lot. You had to show a period of time where you were actually receiving the alimony payments religiously, that it was coming, as scheduled, that you weren't, you didn't have somebody that wasn't making the payment. So you have to show that coming into your account for a period of time. Where are we with that now? What's sort of
that is still the rule, but it gets a little bit confusing. So we'll talk about, again, the FHA versus a conventional loan. Let's talk about the conventional loan first. I'd say most of your clients are trying to get a conventional loan. Okay. So you need to show 6 months of receipt of the support as of your time of closing. So that really ties into why that 60 to 90 days is not always enough time. Because if that alimony didn't start until the day you got divorced, well, 3 months isn't enough. You need 6 months. And I need to see the consistent support pursuant, and it has to be pursuant to a court order. It can't just be voluntary payments for a conventional loan. So you need to show 6 months of payments in full, on time, pursuant to the court order up until the date of closing. Now, we may be able to finesse that if there was pendente lite support or temporary support. We can,
but it has to be supposed to be in an order.
It has to be in an order, and it has to be worded in a certain way that we can actually count it. For example, I had a client that had a support order that said, husband's going to pay the mortgage and the this and the that and the other thing temporarily. Well, I can't count that as the alimony for the 6 month period, because that's not really alimony. He's just paying direct expenses. It has to be unallocated support paid from husband to wife, or wife to husband, or spouse to spouse, for it to count toward that 6 months. Now, it could be a different amount than the final amount, but it has to be more. It can't be less. It has to be more, because the idea being, we need to show that payor was able to pay this much. So obviously they're going to be able to pay this much, and it has continued for 6 months.
So then strategically, if anybody has a case out there right now where you even remotely think that there's some issue with getting a mortgage, that somebody needs to get a mortgage, it might be better to, instead of just sending a letter and saying, okay, we agree that, I'm going to generalize, husband is going to pay all the Schedule A expenses, mortgage, taxes, insurance, and that's going to be the pendente lite arrangement. You may strategically want to say, reduce that to a dollar amount, and say that this amount is going to be paid to the wife by the husband, for her to pay the Schedule A expenses.
Right.
So something strategically like that.
Exactly.
Of course, I'm just already thinking of the people that are like, no way, we're not going to put that in order. But
and I think that's where someone like me comes into play, because I think I can explain, no, here's why. We're not just doing this because wife wants to control the money. We're doing this because if you want wife to stay in the house with the kids, and you want to, be able to get your buyout and move out, well, then this is what has to happen. Or else everyone's just going to have to get a new house and sell the house. So,
or you're just going to have to wait longer on the back end.
Exactly.
Months.
Right. So, and again, that ties in with like the timing of everything. If you're talking to somebody, if you're talking to a mortgage professional during the divorce, then you can bring up these issues and we can solve them. But if I'm being spoken to at the tail end or on the courtroom steps, it might be too late to have fixed a PL order. And we can even go back and amend it so that it, makes sense. Obviously, you can't, once the divorce is over, amend the PL order. But if the divorce isn't over yet, you may be able to go back and amend it so that it can qualify for those 6 months.
Okay, so there could be some creative strategies.
Right. And for FHA, you only need 3 months. It also doesn't necessarily have to be pursuant to a court order. It's a little more flexible. And so sometimes that's a good option. Like, even if you maybe didn't want to obtain the FHA loan, that might work for you if you're really under a time crunch, because FHA loans don't require as much of a period of time of receipt of the alimony.
Okay. But to get an FHA loan, my understanding is that you have to be a first-time home buyer.
No, not necessarily.
Oh, you don't?
No.
Okay.
No.
So
I think it's a lot of times that is who it's kind of like geared toward, but you don't necessarily have to be.
Okay. What do you have to do? I don't know if I'm opening, like, really getting into the weeds here, but
Sure.
Because they're more favorable, aren't they, the FHA loans?
In certain ways not. You might get a lower interest rate, but what will really get you is there's an upfront mortgage insurance payment that you have to pay. And then no matter how much you're putting down on a FHA loan, you're paying that monthly mortgage insurance. Whereas, and that could be, a couple $100s a month, and it could be a couple $1,000s that you have to pay when you purchase the house.
So then why do people do those? Is it because they can't qualify for the conventional?
Yeah, because a lot of times it's the credit, as we talked about before, is that their credit's not as good.
Okay.
So it's like a give and take. Sometimes it really evens out. But that's another thing. Like I can literally show you, like, here's what your monthly payment would be in a conventional loan. Here's what it would be in FHA. Here's what your interest rate would be with each, and so on.
Okay. And also, again, my understanding, I'm not a mortgage professional. So you already told me I was wrong about a couple of things. So another thing that I thought, which may not have been right, is that the FHA loan can be desirable because it only requires, was it 3.5% down?
Yeah, you can put the 3.5% down.
Okay.
Right. Yeah.
Okay.
So, and again, so it's a lot of times first time home buyers, they don't have, if you're like a young couple or something, or, a young person, and you just don't have a ton of money, stored away, then that might be favorable for you. So, yeah.
So do you work with any other types of loans? Because I travel in real estate investor circles, and I know there are some requirements for certain investor vehicles, like that you not live in the property, but I'm hearing that there are other kinds of mortgages that people can get where it doesn't look at your income at all, but you have to be able to put 20% down on the property. Do you work with them?
I don't think we have that type of a product. Other things we do have is like USDA loans, as if it's in like more of a rural area, or VA loans. But that one I don't think we do.
Okay. Yeah. So we're just kind of sticking with the basics today. Like we probably could, really go down some rabbit holes, which
sure.
But we're not going to do that
that's
today.
Fine. Yeah.
But so for people out there that are getting alimony, you said 6 months, they have to show that
receiving it. Right.
So do they have to actually produce bank accounts showing that the money goes into their account?
Yep. That's exactly what you have to do. Yep. Okay. And if it's Venmo, then the Venmo however it is, you just have to produce proof of it. And again, if it's not paid in full 1 month or very late 1 month, you might have to start that clock ticking again.
So, I feel bad then for the people that, obviously would be less so for amicable couples, but I feel bad for the people though, that they have the order, they get the payments, but maybe the payor just doesn't pay on time.
Sure. Right.
Because that's still going to affect their ability to qualify for the mortgage, right?
Well, it's kind of like having a shoddy employment history, right? It's the same kind of a thing. I can't count your income if you're bouncing from job to job and you have 7 months in between, and I can't explain why. That similarly, I can't rely on payor paying you the alimony, and that makes you a riskier borrower. And that's why I may not be able to use it. So I totally feel bad for the person, but that's why they may not. The underwriter might say, this isn't going to fly. So. Yeah.
So for those people that are getting alimony, but their spouse isn't always paying on time, that would probably be a good basis to ask for something to be payable through probation. Because,
for sure.
That has to
be another argument.
But okay, so you were kind enough to sort of give me a little list of things that I want to make sure that our audience gets to hear about, just the basics. So you also mentioned a lien or judgment search. Tell me why that's important.
Sure. I mean, this is probably not that important in many cases, but in contentious cases, or in cases where there's someone who has previous relationships and they may not be a good payer of child support, there might be liens and judgments out there. And if you're the one who, let's just say you never did a lien or judgment search. Let's rewind even more. What is a lien and judgment search? Something done by a title company, and they basically look through all their records and they see if there's any liens or judgments on the property. if you don't do that until after the divorce and you're the one who wants to keep the house and they find something, you're going to have to pay that if you want to keep the house. Like, the divorce is already done. You said you were the one keeping it. If you want to still keep it now, of course, you can file some sort of a post-judgment motion, perhaps. But if you want to get this done quickly, there might be a $15,000 lien, and you'll be responsible to pay it off before being able to refinance. So that's just something to think about. I mean, again, there's cases where you probably think that that's just not going to be an issue, but every so often there might be that type of a case, and that's just, again, it's like a timing thing. You should do that sooner than later, because that could be part of the final judgment of divorce, that husband or wife has to pay this off. So that the other person can stay in the house.
Amy, I don't know if you have this already, but you should really, you must have an incredible network of divorce lawyers, right? From your time practicing.
Of course.
Put together a checklist for
love that. Yes.
To send to people like me. I mean, I'd love to have it, to be able to provide to my clients. And
I'm writing this down.
Yeah, do it. I mean,
because checklist.
I've been doing this for over 20 years, and some of these things, I didn't know. Part of that is because I think the climate has just changed over time. Right. I practiced in a time when it was typical to say 60 to 90 days, and that was okay.
Yeah.
But that's not really the case anymore.
Yeah. Yeah.
And also, I can tell clients these things, but especially when someone's at the beginning of the process of a divorce, they have so many things that they're going through at the time. It's overwhelming. And this is like just another thing that they have to start thinking about. So I think the checklist would be really good to give them something to refer to, give the attorneys, something that they have to continually remind the client about. Yes. And just not lose sight of that with all of the other things that are going on.
Absolutely. Speaking of checklist, I think also in a case management order, I think there should be a provision that if somebody intends to retain the marital residence, they should get a mortgage pre-approval. A mortgage pre-approval is like if you've ever bought a house, and usually you can't go look at houses until you get something from a mortgage company that says, let's say Christina can qualify for a $500,000 loan, and this $800,000 property, she's going to put $300,000 down, and she'll, we approve her for that loan, a pre-approval. It doesn't mean you're definitely getting the loan, but it's like basic information given. I think I will be able to extend this credit to you.
Is it a soft pull on your credit report, on your credit?
It's a hard pull. We would have to do a hard pull. But it's a good question, because you do have to do a credit refresh later on in the process, and that is just a soft pull.
Okay, because I know when you do a hard pull, that actually does affect your credit score a little bit.
So I'm glad you bring that up too, because my husband and my brother-in-law are pretty big on doing social media posts for mortgages are not that exciting, so we try to make it a little exciting. But I think we have a post that we're coming up with one where people think it affects their score dramatically. It really doesn't. It's like a few points, unless you're having it run over and over again in like a 1 week time. It's really like a negligible amount. So people should not be afraid of it.
Cards and a car loan and then a mortgage. It's going to affect your credit rate.
Right. So it won't affect it too much. But I think that if someone says like, oh, I'm going to keep the house, well, kind of like put up or shut up, like talk to someone and show me in writing that you're actually going to be able to do this. And we can actually provide you something that says, yes, they can do this. Or I'm going to say, you can't do this, but if you do X, Y, Z, maybe you can by X date. So, and it doesn't have to be necessarily pre-approval, but I think there needs to be something from a mortgage professional that says, yes, this is a serious, this person can be serious about this. Because if not, again, we could be wasting 2 years of time.
Absolutely. I do encourage that. It could be with my own clients or the other party. Do talk to a mortgage broker. I always tell them to do that, because if we're going to have serious conversations about one person buying out the other, then
Yeah.
let's make sure that they actually can.
Yeah,
before
for sure.
we even go down that road, because sometimes people aren't in agreement with who's going to buy who out.
Right.
So let's make sure you all can even do that before we start fighting about it.
Absolutely. Absolutely. So
all right,
make sure it's feasible.
So I love all this. This is really great information. And I just want to make sure that we touched on everything that you kind of mentioned in the outline that you sent me, because I think we could go down a rabbit hole. I love rabbit holes. I love just digging in, but most people don't really want to get. They just want like the basics. What do I need to know?
I did want to mention, because it kind of dives in with the 6 months of history of receipt of alimony. You also need to show, and this goes for alimony and child support, that you will be receiving it for at least 3 more years after you close on your loan. So be careful with short-term alimony.
Or that long.
What's that?
That doesn't. I'm sorry. That doesn't even seem that long. 3 years.
Right. Yeah. But we just need 3 years. I guess we need to see the 3 years, and after that, you're kind of on your own. I get that's a good point, because it's like, well, what if all they get is the alimony and they get it for 3.5 years, and then what happens after that? I don't know. I don't make the rules, so I guess we just assume they're going to be okay after that. But 3 years.
Okay, well,
and 3 years child support.
Maybe the assumption is that by then there will at least be some equity in the house.
Sure, that's true. Right.
Okay, so you brought up an issue too that I think is really important, and I'm so glad you brought it up, because this has come up in my cases a lot recently. Sure. The myth of loan assumptions. Tell us what that is and why that's a myth.
Yes, and I think I'm posting something in a day or two about this, but the loan assumption is, this is what I think happens. People call their lender and they say, can my loan be assumed? And the lender says yes, because perhaps it is an assumable loan, but that doesn't mean that in your particular situation, a loan assumption will work. So it's just like this thing that doesn't usually actually.
Just for people that don't know.
So an assumable loan, I really means that somebody just takes over the loan just as it is. I'm not even sure exactly, because I just know so often that it doesn't work.
Is this the same as assigning a loan, or are these two different things?
I don't think so. I think it's two different things. So I'll back up real quick. So a loan assumption is not possible under a conventional loan. When you sign your final loan package at closing, it literally says this loan is assumable or is not assumable. It will say not assumable when it's a conventional loan. So this is more like your FHA loans. I think the VA loans are also assumable. And basically you just take over, like if it's 2 people on the loan, it's 1 person going on the loan now, and then just kind of taking over where it left off. And so that sounds great, right? But you still have to qualify for the same terms that you did when it was 2 people. So
so you could keep the same loan terms.
Yes.
So really it's just like taking your spouse off the mortgage, because usually that's what we're talking about when somebody wants to stay in the house. There's this refi issue, because usually the one that's leaving does not want to stay on the mortgage. So that means they have to refinance it. That the spouse that's remaining has to refinance it. So I think what you're talking about is, well, we'll assume with a husband here, a husband can move out, we'll do paperwork, and the husband will come off of the loan without having to actually do a refinance.
Right. But when you really get into the weeds with it, it just doesn't always, it very often doesn't work out.
Because you still have to qualify.
The spouse staying behind
still has to have
exactly. And there's still a whole lot of other like red tape and things like that.
Okay. So, well, let me ask you something though, because something I'm seeing now is because people are locked into really good old rates and they don't want to do a new one because the rates are kind of crazy right now. Is that a situation where you see that where people want to just assume the mortgage so that they don't?
Yeah, and that's what they want to do. And listen, if you can do it, do it. It just doesn't usually work out.
Oh.
I think, we just don't see it. I'm coming out with a social media post that shows basically what I did was I interviewed all these different title agents that have been in the business for 15 years, 30 years, 40 years. And they're like, I have not seen it, because you still have to go to a closing and sign paperwork, and the title company usually handles it, or an attorney's office. And they're like, I have not seen one since the 90s, or I've done 2 in my 35-year career.
But why? Is it just because people don't know what it is, or the banks don't want to do it?
I think the banks don't want to do it, right? I think the banks don't want to do it. So they make it difficult, and it's difficult to qualify for the same exact thing with one person as you did with 2 people.
Okay, I'm going to go off the script a little bit.
Sure.
Loan modifications.
Sure.
Do you do anything with that, or is that something usually people just do directly with the bank?
That's something they do directly with the bank. I've seen that more like during COVID, or if there's like, an economic crisis and people basically just modify the terms of the loan. I think they can like extend the term or lower an interest rate. I'm not really sure, because we don't do them. But that's something you deal with directly with the bank. And that's more like if you have an existing loan and it's modifying the terms. I don't think it really coincides with divorce so much, because I don't think it's ever having to do with like removing somebody.
Okay, no, the
great
context
question.
I've seen it is when you have a situation where people, play these games and somebody stops paying the mortgage, and then you end up being months behind on the mortgage. Yes. Let's just say, husband is, I'm not picking on anybody, we're just generalizing. Husband isn't paying the mortgage, is supposed to be paying the mortgage, but isn't. And so now you've got this period of time where potentially it could go into foreclosure.
Yeah.
And then they do a loan modification so that they don't have to, basically what the deal is they don't have to pay all in one lump sum the 6 months that they didn't pay. And what the bank does is they just add the balance.
Add it to the back.
On the back end, and, paying it. I've seen that happen a bunch of times. I don't know if I've just gotten lucky in recent months, but I've seen this a few times now.
Sure. But I will say where that might come into play, though, is if you want to refinance a loan, we do have to show that we sometimes need a 12-month history that the loan being refinanced, the mortgage being refinanced, has been paid in full for the last 12 months. So if you recently did a loan modification, right, and you maybe hadn't paid for 6 months, that might like toll the time there. So you might have to wait for that.
Okay. So you could still have all the things. You could have the good credit. You could have the alimony going into your account for 6 months. You could have all that. But if you had a loan modification in the past 12 months, that could be the thing that holds you up.
Right. You might need, again, more time to be able to do the refinance.
Okay.
Yeah.
All right. So we went over a lot. I think this was all great. We started to squeeze a lot of value into about a half an hour.
I know. Oh my God.
Is there anything that because this is what you do, is there anything
there's one thing I want to talk about too, is like a huge thing. And we've been seeing this a lot, even with our non-divorcing clients, is getting a cosigner. The cost of getting a house nowadays is just, not only are the home prices higher, homeowners insurance has definitely been going up. Let's see, I made a list of like things that make it more expensive: a homeowners insurance, housing costs, and interest rates obviously have been going up. So someone who may have been able to qualify for a $500,000 house a few years ago, they might not now, because it's just that much more expensive every month. Like we talked about, the debt to income ratio might just be a little bit off. A really easy fix sometimes is to get a cosigner. And that's just somebody else that will go on the loan with you. That sounds
so easy, Amy. You act
like it sounds so easy.
Just go get a cosigner.
But I do think in the divorce context a lot, there are parents who might be willing to help out their child if they want to stay in the house with the grandkids or something, or an aunt or an uncle, or someone who's willing to just kind of go on the loan as well. I mean, it does mean they are liable for it if it doesn't get paid, but it's sometimes, instead of like loaning somebody money, they might just feel more comfortable. Okay, instead I'll just go on this loan, with my friend or my family member, and that would be just like an easy way to get them to qualify. Like, because we can use that co-signer's income to kind of push them over the limit and get them into that house.
So do they actually just kind of combine the income of that other person with, if I'm the applicant, it would combine?
Yeah. For the most part, that's how it works. So like, I mean, I just talked to somebody today and I'm like, listen, they have alimony and they have income, but it's just not enough for them to refinance in their own name. So if they have anybody else with even just decent income that could go on this loan, and they have to have decent credit too. You know, this person can't have a 500 credit score. They have to have a good credit score. That could really help, and this person might be able to keep the house as a result.
And is their debt to income ratio also considered in that too?
Yes, absolutely.
So they have to be able to qualify for a loan themselves.
Exactly. But they might not be able to buy the house themselves. Your client might not be able to buy the house themselves, but together, we can make magic happen.
Well, that makes sense, because that's how usually the married couples did it too.
Exactly.
Okay.
Yes.
All right. Well, this is really good information. I feel much more educated in just a short period of time, Amy.
I'm so glad, Christina.
Now, I want to give you a plug. You said you're doing some stuff on social media, and I think that I want to check that out. So where should people go to find you?
So if you want to find me on Instagram, it's Amy Mutt Mortgage. I'm making sure I don't have two T's there.
M-U-T-T?
No, it's hold on. It's Amy Mutt, AMY. MUT Mortgage, and that's my Instagram handle. You can also follow the Malamut Mortgage Team on Instagram. Let me make sure.
I'll put links to all of this in the comments.
Yeah, that would be great. Yep, Malamut Mortgage Team. Just spell it out: MALAMUT Mortgage Team. That's like our whole team. I work with my husband, my brother-in-law. We have a great team.
Family operation.
Yeah.
I really can't say enough about, I think it's so valuable that you have this experience as a divorce lawyer too, because you can really understand things on a different level.
Yeah.
So thank you. Thanks for making time for me and sharing all of this. And I'd love to have you on again. And I will fully expect a checklist from you.
I love the checklist idea.
But
I have to give you credit for that.
Yeah, I think it'd be really great. I want it, and maybe we can, at some point, we can even put a link so that whoever's watching this can have that. So thank you.
Love it. Thank you.
All right. So you have been watching or listening to Lawyer Radio, the official podcast of Wolf Esquires, and I'm your host, Christina Previte, with Amy Malamut, and we're here every Friday at 12:30 p.m. Eastern Standard Time. We'll see you next week. Thanks for watching.
See ya.